still be a counter to the monetary policy, and will monetary policy, will the Fed figure it out quickly enough to kind of back off and not kind of have a recession and overcompensate for inflation like it has in the past in some cases, or does it have to wait for a crisis and a recession to happen and then come along, throw money around and panic and try to stimulate?
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have Sam Burns. Sam Burns is a CFA. He's the Chief Strategist at Mill Street Research. It's an independent research company specializing in proprietary institutional research tools for asset allocation, stock selection, and macroeconomic indicators. Sam has more than 20 years of experience as a market strategist, providing U.S. and global investment insights at Wall Street firms, including Oppenheimer & Company, Brown Brothers Harriman, State Street Global Markets, and Ned Davis Research. And today he's going to join us and try to read the tea leaves and figure out where the economy's been in 2023 and where we're going in 2024. Stay tuned. Sam, welcome to the show.
Thanks for having me on, Chris.
Yeah, I'm very excited. As listeners know, I'm a bit of a economic geek, and I love to talk about the data that's out there. And we heard from your team, and I've been reading your weekly roundup as well, which is fantastic when it comes to data. And everybody wants to know what the Fed's going to do. Everybody wants to know what the latest research is. And, I figured we could take the next half hour or so and spread the tea leaves out on the table, Sam, and see what we can figure out here for the end of 23 and going into 2024. What do you say?
Sounds like a plan. Happy to do it.
Wonderful. Well, before we get into that, if you would, please share with the audience a little bit about your background, what you do at Mill Street Research, and then we'll get into what we're going to chat about today.
Sure. Yeah. So I'm running Mill Street Research here in the Boston area for the last 7 years. And for pretty much my whole career, I've been doing, equity markets, asset allocation, global economics, quantitative stock selection, mostly for an institutional investor audience. So most of the people that I talk to are professional investors in some way or another. And some of them are running real small, investment advisory firms or big mutual fund companies. So they're all over the place. But I've also expanded more recently, offering the weekly roundup note you mentioned, which can maybe be of interest to individual investors or small investment advisors who want kind of a slice of what I offer to institutional investors. The idea is to have a framework, to have a structure, to have indicators and data that you know and rely on, and have a way to come into work every day and indicators that are relevant, as opposed to getting kind of swung around by whatever's in the headlines every day, which a lot of even the professional clients I talk to still struggle with. They get carried away with whatever the kind of meme of the day is, and lose sight of kind of the fundamentals or what they should really be focused on and what really is relevant, as opposed to what's most exciting. And so I think that's been my goal overall, is to provide data and indicators and information that clients can use and kind of weed out a lot of the noise and things that really aren't useful.
No, I love that. And, we hear about the smart money, right? So, a lot of people are retail investors, and a lot of, people listen to the show because they want to, gain some financial education. And, a lot of these listeners are way ahead of, kind of the retail money. But that's one of the things I like about real estate, is it moves a little bit slower than the stock market. So, those of us that aren't as smart as you, we can kind of bet on some of these slower trends. But I know we've had a lot of, we're recording this right after Thanksgiving here. And we've had several different pieces of economic data come out shortly before this. So I want to cover some of the broader economic data, but also dive deeper into some of the more specific real estate data. But maybe you can kind of do an overview about some of the data that's come out here in the past month, especially for people that aren't used to following it like you and I are on a regular basis.
Yeah, no, I think this last month of November has actually been a pretty dramatic kind of, it's provoked a pretty dramatic in markets, both stock market and the bond market, interest rates. A lot of September, October, and even back in August, people were worried that inflation was going to stay high, that the economy was too strong, and that the Fed was going to have to keep tightening, or at least stay tight for a long time. And that was pushing, the long-term bond, higher, getting much closer to where short-term rates were. and got people very kind of off kilter. It also provoked, I think, some worries and some forced selling even amongst banks and some of the hedge funds and leveraged investors who deal in the fixed income market. Then we had the Fed meeting at the beginning of the month, where Fed Chair Jay Powell basically said things that were interpreted as meaning that they're probably not going to raise rates anymore from here out. That they've that there's been enough progress on inflation, the rates are already pretty high, and that they don't really need to raise rates further to keep inflation on a downward trajectory. And then we got good PPI report, the whole inflation, retail sales numbers were relatively soft. So it basically all then confirmed, the data kind of came in saying, yeah, actually things are kind of better than expected or slower than expected. There's not too much going on in the economy. It's not inflationary pressure. And that's allowed bond yields to come back down again, allowed the stock market to rally pretty sharply, and kind of eased a lot of those concerns about, there's too much inflation pressure, or the Fed's going to have to keep tightening. So I think we're now in this kind of scenario where the Fed's not going to cut rates right away, but it's probably going to just stay on hold for a while longer. And that's kind of allowed the markets to act a little better. And then, corporate have been pretty good, not spectacular, but pretty good overall, particularly the larger companies. And so that's kind of, helped the stock market, hold up a lot better lately. But that's kind of been the trend. It kind of reversed from September, October into November. And so a lot of people are feeling a little bit better now about things that were this time last month.
Yeah, it's really, I was kind of trying not to chuckle when you were saying it, but you kind of caught yourself. You said, it was better than expected, and then you said slower than expected. The Fed's been in a war on inflation, and CPI is the consumer inflation index. Do you mind sharing what the difference is between CPI and PPI for listeners real quick?
Sure, yeah. So the CPI, the Consumer Price Index, is the main inflation index you probably have heard about, and it makes most of the news. And it's a measure of what consumers pay for things across the board. Kind of, they basically take an average basket of what U.S. consumers buy, and with the weights of what they spend their money on, and then track the prices of those month after month, and then track kind of what the average consumer basket costs, and build that into an index to show how much consumer inflation there is. So housing, it's got food, energy, all the things you buy at the store, all the services you buy, everything that a consumer might buy. The PPI is the producer price index, and that's a different measure that's measuring what businesses charge each other, essentially, what they're paying for goods and services. So it's all the raw materials they use to build things, or the intermediate things they use when they're building either whether it's goods or services. It's a kind of business to business wholesale inflation. And so what often happens is that the wholesale prices, the business inflation, kind of moves first, and then it kind of filters through down into prices at the store when you go to the grocery store. And so a lot of people look at the PPI as kind of a leading indicator in many cases for the CPI. Now, different things in them, so they don't always match up exactly, but that's kind of the general idea of it.
Wonderful. Thank you. And you said, CPI, the print came in lower than was expected. And, the Fed's been really on a tear here for the past, solid year on inflation. And the tool that they've been using is raising interest rates. And, when we raise interest rates, we raise the cost of money. And in general, it slows the economy down. And we've seen that, what we were up to, did it hit 9%? CPI at 9% last year? I'm trying to remember exactly.
Just under, high 8%. Yeah. Last year.
And now we're back. Was it 3.2? Was the latest
3.2 was the headline. Yeah, that's right. That's right.
All right, I'm on it. Okay, good.
That's right. You got it.
Ooh, you're making me sweat here, Sam. I got to be on point for with you here. But so that's a massive drop, right? I mean, we've seen it drop faster than almost any other time in history. So that's a win for the Fed. And I know a lot of, it's interesting. So the stock market went up, after that. And we've seen it rally on this. Why is that? Why would the stock market go up if it seems like the economy is slowing down?
Right. And that's the kind of the push and pull there of what the economy is doing versus what the Fed is worried about. Right. And basically it's a sort of idea of, if the economy is too strong, the Fed gets worried that means there's going to be inflation. That if the economy is running past its capacity, then that's what causes inflation.
Yeah.
Now, I guess there's two things here. One, that's what the Fed has historically done, and the markets have kind of built that into their thinking. So if they see economic data that looks like it might be too strong, they're like, "Oh, the Fed's worried. You're raising rates. That's bad for stocks, and will slow the economy, maybe later on." And so they tend to be more nervous when rates are going up, or they think the Fed might raise rates. Now, if you actually look at the data, that hasn't really been true. We haven't really had a problem with too much growth causing inflation for decades now. And it's really been supply shocks like COVID, or oil shocks from OPEC, or Russia invading Ukraine. Those things are what actually caused most of the inflation that we've had, not just people having a job too much or something like that. But the Fed sometimes kind of gets a little worried about things that it shouldn't worry about. So that's what the market tends to respond to. So if you see inflation coming down and you see the economy slowing down, there's probably not going to be much inflation, and therefore the Fed won't be a worry anymore. And then the market tends to like that.
Yeah, no, I think that's a great point. It's sometimes, I think, can be very confusing to people when they see these numbers come out. But it's important to remember that the stock market is really a predictor of the future in a lot of ways. It's a pricing predictor for these companies. And with the cost of money, if it continues to go up, that then the stock market ends up pricing in that to the cost, or the PE ratio, I guess would be fair to say, with respect to that. And you mentioned something else. I think when I was looking through the data, one of the big drivers of the reduction is oil prices are down a lot, which is great. Hopefully, it looks like maybe the war in Ukraine will be winding up. It looks like there's been some resolution in Israel here recently. So I'm definitely keeping my fingers crossed on all those things. And those things are all really, have a big impact when it comes to inflation here. And hopefully that helps out people around the holidays. And as we go into the heating oil season, I would like to, I'd like to touch on, some of the real estate stuff here, Sam, because, I think, interest rates really play into this. But before we do that, you mentioned that it wasn't really that people had, there weren't too many jobs. There almost wasn't like too much money. It was because we had these supply shocks. And also we had all this stimulus, right? Like I don't know what the exact number is, but I know at the beginning of the year when I was at a conference we were talking about, there was like $6 trillion of liquidity on the sidelines, and still credit, is abundant. Like, it was still easy to get credit. And I always look at that. Like I try to track these bigger trends, like kind of like tidal shifts going in and out versus like the waves. And, the way I saw it, I was sitting on a panel about a year ago. I was actually supposed to be on it this week, but I'm going to be out of town again. And my co-panelist said, we're going to have a big crash in the market in 2023. And there's going to be a big economic. And I was like, I said, I just don't see it. And, I look at like what Ray Dalio says, and I track the real estate market. And, with the price of real estate and land and all this liquidity in the market, I said, I just don't see it. Credit's abundant. I said, and then we have this $6 trillion, bolus of liquidity just floating around out there. And if a deal comes up, even if it's not a great deal, if it's a pretty good deal, I said, I think people are going to pounce on it. What have we seen with respect to, the liquidity and the money supply, M2, I guess we could talk about, and how does that play into, the price of equities and the price of real estate, Sam?
You're right. It's been a crazy few years here. And you had COVID, which of course shut everything down for a little while. And you had the huge stimulus that came after it, all the, check out people and everything else. And then after that died down, a lot of people did, like you said, assume that once that stimulus ended and then the Fed started raising rates to really tighten monetary policy, you would then have, recession, severe, drop off in earnings and everything else in the economy. And then that didn't happen. About the last year, I maybe like you, everyone I talked to in the media or even clients were super bearish, expecting the world to end. We're going into recession any minute now. And that, it didn't happen. We turned out the economy kind of stabilized, never went into recession, is actually doing better now. And I think part of that is because a lot of those supply shocks got resolved. And also because there was a second round of stimulus that was from the like the CHIPS Act, the Inflation Reduction Act, the Infrastructure and Jobs Act, all those things that were kind of a second round, were much more focused on investment related, kind of building bridges and factories,
Yeah,
and
infrastructure. Yeah.
yeah, manufacturing and infrastructure, and
Yeah.
spending on that has really gone up quite dramatically. I think that's what's allowed the U.S. economy to do better than expected this year, relative to what people expected it to do, and also relative to other economies. Europe or China or most other economies in the world haven't had the same fiscal stimulus that we've had, and they've done worse. So I think that's been the kind of the key factor keeping the U.S. economy in much better shape than it would have been otherwise. And so I think that's helped offset the effect in some ways of monetary policy getting tighter, the Fed raising rates, which normally would slow the economy down quite a bit, and push the stock market down and all those things. But now you've had kind of that counterbalance from fiscal policy, which we haven't seen really in this way for decades. So it really caught a lot of people by surprise. It's been a big sort of shock in some ways, but people forgot about it once those legislation got passed, and now we're seeing the effects of it. So I think that's also affecting real estate to some degree, in the sense that there is that kind of money around to do things. Now, some people have gotten some commercial real estate that's gotten into trouble, and the banks have felt some of that because everybody's going back to the office after COVID. And so some commercial real estate that's not being used as much. But the residential real estate market's held up quite well because people have jobs, people are getting raises, they can afford the house, they just can't afford the mortgage as much. It's the cost of financing is the problem. And so this kind of weird balance of there's not much on the market in terms of residential real estate inventory. People don't want to sell and give up their 3% mortgage to take on a new 8% mortgage. But the people who want to buy are nervous about taking on a high mortgage or paying up for it. They want to wait for prices to come down. They haven't really come that much. So you've got a kind of a locked market in the residential side. At the same time, there's a lot of multifamily housing being built, apartments and stuff being built, a lot more so than even single family housing. So I think that's where a lot of the new building is going on. And so there may be more supply coming in that regard, which will help keep rents, or the rent growth, I should say, lower, as it already has started to.
Yeah, no, that's a great point. And we have over 3,000 units on the apartment side, well, over 3,500 now, and several of those communities are build to rent communities. So we track the single family pricing and rates and all that stuff. And yeah, I mean, we're still at a massive shortage in this country of somewhere in the order of 4 million units on the apartment side. We can add a couple million more units on the housing side, or even more when you look at affordable housing, because we have record household formation as the millennials are coming out and forming households and doing that. They want a place to live, whether it's an apartment or a townhouse community or actually their own single family house if they can afford it. So as you were mentioning, like the market's locked, people aren't selling their homes. That means supply is lower and demand's still high. People still want to do that, and it's largely it's largely inelastic a lot of times when it comes to that. So where do you go? You go to one of those three, which has been really interesting to see that play out. So yeah, that's why I'm still bullish on specifically the multifamily side. We have a lot of supply coming on. It's muted rent growth to a degree, but rent growth has still been positive this year. And there's been some pockets. What have you seen in terms of this was one of the things on my notes here. What have you seen on term building permits, comparing multifamily versus single family, Sam? Today's show is sponsored by Money Insights and their investment optimizer strategy. In my book, I share how I use this same strategy starting over a decade ago to invest my money in two places at one time. This strategy has been used by the wealthiest for generations for estate planning, minimizing taxes, preserving wealth, and increasing stability for their investments. Now you can do the same thing. In addition, you can build a plan to build an emergency fund, pay for college, fund a business, plan for retirement, and ultimately optimize your total financial picture. To find out more information, check us out at the banking link at nextlevelincome.com.
Yeah, it looks like the multifamily side has been much stronger than the single family side. The single family side has held up surprisingly well, given the sort of 7 or 8% mortgages, which normally you would think would just crush, new home buying, but also new home construction. So So we've seen that the home builders that I track in terms of their stock prices and earnings had been holding up much better than expected. They've actually weakened some in the last, I don't know, just say month or two. As I think they're finally starting to feel the bite from the higher rates. But I think overall there's still that demand, like you mentioned. A lot of people want to own homes, and during COVID, of course, people didn't move. They just stayed where they were, wherever that was, or they tried to move out of the city centers and into the suburbs if they could. But there's still, I think, a lot of that kind of dislocation and kind of pent up demand from things that didn't happen for a year or two during COVID that we're still trying to work out. But they're just trying to work it out with the much higher mortgage rate than most people are used to. So I think multifamily has been where more of the growth has been. But there is still some growth in the rental prices, just less than there was, a year or two ago, which is good. We don't want to have double digit rent increases.
Oh, it's crazy. Yeah, we were seeing 25% growth in some markets year over year. Yeah.
So I think, like I say, as long as the employment market, people have jobs and are getting raises, and so far that's still true, then the underlying ability to pay for a home is there. And that's really, I think, the key driver, that their desire to own homes or to rent, to have a home, and there's the income to pay for it. And then it's just a question of the financing side of things, depending on who you are and where you are. And then, of course, there's all the local variations, depending on where in the country you might be and what you're looking for. But so that's what I've noticed in the data, that it is more multifamily than single family, but both are holding up better than if I just told you mortgage rates were at 8%. You would have probably predicted, much weaker kind of data than we're seeing right now.
Yeah, like a catastrophe. It's interesting because we've had a ton of supply this year. We'll see a solid supply next year in terms of apartment units, but starts were down because as rates went up, a lot of builders, developers said, whoa, can't afford to do that right now. It doesn't make sense. So I think that'll kind of shift and moderate back, and we'll still see. I think we'll still see consistent rent growth here over the next several years as we kind of move through some of this newer supply. But like as you said, it's going to help keep rent growth at a healthy rate. Not this crazy 10% or 20% rates that people can't absorb. The other thing you mentioned was infrastructure spending, and this is something that I kind of look back. I look at the real estate market kind of in these. And some listeners will smile and nod when they hear me say this, like an 18 and a half year cycle. And as it ebbs and flows towards the end of the cycle, we see this infrastructure spending. You mentioned decades. You can go back, kind of the beginning of this century, but really, going back, another almost 20 years, we saw a lot of this spending. We're seeing it in just general infrastructure, which we desperately need in this country in a lot of areas. I think, next year with a presidential election year, I think we'll see. I don't know. I think we're going to see some sort of stimulus as the Biden administration tries to, and maybe that comes in student loans, maybe it comes in infrastructure spending. I just feel like there's going to be more fiscal stimulus in some way, shape, or form, which is interesting with the Fed trying to fight inflation and the government, fueling the fire on the other side of things. And then one thing I was just reading about here this morning is the White House just announced a new program to help convert offices to apartments, which I get asked all the time. People are like, hey, is this a big, but it's not, there's a very small percentage of that. Any thoughts on that, or what you see in terms of that in general, kind of like bigger trends? This is something I've kind of seen. We saw it with condo conversions, but this is something that's fairly unique in my experience in the past, 30 years.
Commercial real estate, kind of operates, and there may be a permanent, X% kind of decline in demand for, commercial downtown office space, because more people are just comfortable working from home. People have office kind of desk jobs, and Zooms and things have replaced X% of the former demand for commercial real estate in some ways. And so if there is something to be gained by taking some of that downtown, particularly urban office space, and converting it into apartments, places where people want to live, but that has been too expensive historically, that might be something that would, help kind of balance that out. That there's still demand for places to live, but slightly less demand for places to work. And so that maybe balance that out. Now, I know it is, just as a practical matter, tricky to convert something that was built as an office building into something that can be a housing unit. It costs a lot of money. But if the government's help and some people who have incentives to do that, then that might be one way to do it. think you're right that, in generally speaking, that fiscal policy, helping infrastructure, roads and bridges and airports, but also building electric vehicle factories and everything else that's going on right now has been a key kind of underlying support, both for people having jobs, but also for building out kind of the productive capacity of the economy and making it easier for things to happen. So I think that's been a key variable in terms of what's different this cycle versus previous cycle. I think, the administration will try to do as much as it can in that regard. I think Congress will be a sticking point. I think it'll be harder to get anything big through the current Congress as it stands. But other things and then the legislation that was already in place will last for a while. It's got kind of legs.
It was over $1 trillion. It was what, $1.1 trillion dollars, and I love what it was, Inflation Reduction Act. That's funny. Like, I had to laugh when you said that, because it's just like it's what the government likes to do, right? They name things that are really the opposite of what it is.
Right. It all depends on how you spend the money. Yeah, exactly.
There you go. Yeah, it does. Yeah, we're gonna spend money and reduce inflation. Okay. But no, it's infrastructure in general. I think we got if we're gonna have all these electric vehicles, we need to upgrade the electrical grid. It'd be great to have some more onshoring with respect to a lot of the technology that we have. And I'd love to hear kind of your thoughts on that, how you kind of share with your readers and with your research how we can predict that. But before that, let's talk a little bit about kind of where we've been with interest rates. I know we touched on it a little bit this year, and kind of where you see rates going, because I don't know, in my perspective, the Fed seems to always kind of wait too long to raise rates and then overshoot and then wait too long before they lower rates again. And the rate curve is still inverted. So, I know a lot of people are like, hey, this is why we were calling for a recession. We haven't seen that. What are your thoughts on that kind of historically? And what is your research showing with respect to rates going forward here in 2024?
Well, I certainly would agree that the Fed often, is behind the curve and kind of, causes more problems than it solves in some ways, trying to kind of adjust rates to tinker with the economy when there's a lot going on in the economy that is driven by Fed policy. And they respond to things that are maybe supply shocks or other things that maybe they shouldn't be responding to. They're causing volatility that doesn't need to be there. So I think I don't think they're going to raise rates any further. If they called me and asked, which they don't, but they should. If they ever called me and asked, I would say the rates are probably already too high and could come down some. I think inflation is already close to their kind of 2%-ish target, if you account for the fact that the housing data that's in the CPI is lagged. It's slow to move because of the way it's constructed, by definition. I think they're aware of that, but they can't, as a kind of a publicity thing, they have to kind of keep the perception that they're still fighting inflation as long as it's above their target. So they can't come out and say, "Oh, we're going to stop raising rates or cut rates soon," because then that would look like they're giving up on their inflation fighting credentials. But a lot of that is, again, a public perception. The Fed can't really control inflation that well, and never has been able to. But they're supposed to, so they act like they do. The fiscal policy that actually has a lot more influence than monetary policy does in kind of reality, but that's harder to pin down. So I think there will be rate cuts probably next year once the official inflation data finally catches up and shows that inflation is down to around 2% next year. Then the Fed will have a harder time saying that they need to be at 5 or 5.5%, and they'll probably bring them down some. If they do that without a recession or a crisis, that would be the first time really since probably 1995 that's happened. And in 1995 was actually kind of the last real soft landing you could say we had, where things slowed down but didn't stop. And then the Fed could cut rates a little bit and keep the economy going for another few years. And if that were to happen, which I think has a decent chance of happening, that would be kind of the good scenario. Stocks would do well, consumers would do better. That would be kind of what you want to see. The risk is that either they over tighten or stay tight too long, or that fiscal policy suddenly gets thrown in reverse, and that the federal government, Congress, decides to cut spending aggressively and really contract fiscal policy, and so you have contractionary fiscal policy and contractionary monetary policy at the same time, and that's usually what drives you into recession. So
Yeah.
2000, 2008, 1990, a lot of these things are when you had that combination of monetary and fiscal policy, both in contractionary. And then, shortly thereafter, you had a recession. And so I think that's the risk that we're having to look at in 2024 is, will fiscal policy be enough to kind of still be a counter to the monetary policy, and will monetary policy, will the Fed figure it out quickly enough to kind of back off and not kind of have a recession and overcompensate for inflation like it has in the past in some cases, or does it have to wait for a crisis and a recession to happen and then come along, throw money around and panic and try to stimulate?
Yeah. No, I think it's a good. I mean, I look at it and I think, okay, this would be an easy way for the current administration to work with the Fed to help juice the economy without having Congress in the way of blocking that, because you would really throw a lot of fire back onto the real estate market. You could say, hey, we're increasing housing affordability by encouraging these policies. You can, you throw, because look, multifamily is really the only commercial sector in terms of real estate where, there are federal agencies that are actively trying to improve this. So I'm like, okay, I could see that. I could see that happening to help give this administration at least some sort of wins as they go into the election. And then, itself into a corner with raising rates, because you look at the cost that we're paying in terms of interest rates. And I'm like, it's just financially impossible to keep rates high and keep these deficits so high as well. We're going to end up paying out so much. So I don't know. I look at them like, what's the end game? You think like if they want to keep the music spinning a little bit longer, music on a little bit longer, then you got to lower rates and do that. So I feel like that would be a pretty easy way to get there, but we'll see. So maybe they will call you, Sam, and ask for your opinion, and you can chime in.
You never know.
But if they don't, they can read your weekly roundup that we were chatting about at the beginning here. And what we haven't talked a lot about how to get into stock picking and how we talk about the stock market and those sorts of things. So if you wouldn't mind, kind of do a little overview about what we can see in your weekly roundup and what you share with your readers on a regular basis.
Sure. Yeah. So the weekly roundup is meant to be kind of an overview or summary of a lot of what I offer to institutional clients that I work with, both in terms of asset allocation, kind of should you want to be more on or risk off in terms of your stocks and bonds, your general portfolio. Should you expect things to be relatively low volatility gains, or is it going to be a risky period? And so I update that. There's a model that I use. Again, the idea of having a well-defined, objective set of indicators to look at, kind of reading every day and getting carried away by whatever the journalists are writing. Have a set of data that historically has had a good relationship in terms of forecasting future returns and risk. So that model is in that report every week and kind of allows you to kind of track, whether conditions are improving or deteriorating. In terms of the overall risk that you want to have in your portfolio. And then it also offer sort of macro commentary, kind of describing what's been going on, and whether it's in the macro data that we talked about, or investor sentiment, kind of what people are saying, or different sectors or regions in the world, whatever is really kind of relevant and topical in terms of the indicators that I look at from an investor standpoint. And there's also a stock selection component where I have a model, a quantitative process for identifying stocks that have improving fundamentals, good price trends and good valuations, and just giving you a list of 20 stock ideas that look really strong in my work, and then a list of the lowest ranked, the weak stocks that you probably want to avoid, and as sort of an idea list of things. If you're looking, you've maybe been looking at some of these names yourself, and you see them on my list, then that's maybe something to look at to buy. But again, it's meant to kind of provide a framework, some commentary and ideas for investors who are maybe a little more active or managing their own portfolios and want some ideas that are based on long-term, time-tested indicators that professional investors use and pay a lot of money for. And so you can get it for much less there in the weekly roundup.
Yeah. Now I got a issue pulled up right here. So I was going through it as you were going through, and I like it's concise, it's digestible, and it covers a lot of the macro stuff, which, like I said, a lot of pictures. Yep.
Yeah.
Absolutely. And yeah, look, I'm an economic nerd, so I absolutely love stuff like this. So it'll be in the show notes if you want to check it out. You can click on the link there and you can learn a little bit more about Sam's weekly roundup. It's at millstreetresearch.com/weekly-roundup. Again, we'll have that in the show notes. And Sam, I could chat about you with this all afternoon. We'd pour ourselves a drink and continue on into the evening. But I'm going to have to let you go, but would love to have you back on here in the future, and we can continue to look forward and backward and educate the audience here on what we see coming up. So thank you so much for sharing your knowledge with us today.
Oh, it's been a pleasure. Thanks for having me on, Chris.
Absolutely. Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.